Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, I'm going to discuss some very interesting findings to emerge from recent research, holding that there is a risk management paradox at work. And the paradox is that risk management will be at its most costly and difficult to execute when we most need it. And if this holds true, it has serious implications for how we go about risk management in firms. We need to get our risk management in place before it's too late and the paradox kicks in, making it too difficult and costly to reduce risk at that point. So, all right. Please read more about the paradox in my book, Empowered Enterprise Risk Management, co-authored with Peter Kapstein. There's also more information on my website, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so if you take research on risk management in general, there tends to be a very favorable view of it. It's presented as a largely unproblematic activity in firms that produces some benefits, mostly understood in terms of keeping firms out of financial trouble. If you have designed a risk management strategy to generate some cash inflows in a downturn or when you're financially weak, that is going to be helpful overall. So it has that sort of benefit, but rather few descriptions of any costs or drawbacks, anything along those lines. That's it's a very rare thing to see that in academic research. So maybe that is a tad too positive. We'll see. Anyway, what follows from that would be that the closer you are to financial trouble, well, the more you want it. That seems to be a logical step, right? That kind of conclusion, because as the probability of financial distress then goes up, so does the expected cost of financial distress, because the cost of financial distress is the probability of it times the cost of financial distress. So whenever the probability of financial distress is on the rise, and you know that ought to trigger some response in terms of risk management, right? And the higher the probability, the more you desire risk management essential. So the reason being, of course, that risk management presumably can reduce this probability of financial distress. I mean, a well-designed risk management strategy will tend to do that. So why not? You know, that seems legit. And so what we have essentially, the view on corporate risk management in the literature is that there are certain negative consequences that are triggered at low levels of corporate performance. So the further corporate performance falls, the more of these negative consequences you're likely to see realized. For example, at some point here in a bad scenario, there may be some underinvestment. You may struggle to find enough internal cash flows and external financing to actually execute your business plan, which is a negative thing then if you have good investments, but you're unable to execute them. If performance falls even further, you might find yourself in a situation where you have to consider selling assets. And that's something you would probably like to avoid, because when you have to make rapid asset sales, you're quite likely to have to accept some kind of discount, because it's a fire sale, right? So you're going to be willing to accept a lower price than otherwise. So that's a negative outcome for sure. Then we have what is referred to here as a stakeholder risk premium, which is when people, customers, and suppliers and others become unwilling to engage with you because they see you as too risky. Like they can't be sure that you're going to be around, a few months from now, and it's too risky to have dealings with you because of your significant risk. So when that kicks in, they start voting with their feet, right? So your competitiveness suffer, which exacerbates your risk, right? So, and push it even further, there will be the possibility of bankruptcy, right? And you have all these fees to lawyers, and you divert managers' attention away from running the business. It's a pretty bad spot to be in, and all of these and others count as part of the cost of financial distress. So if you can reduce that probability with a hedge and try to ensure that your outcome is actually around here, or preferably keep some upside, but you don't want to expose yourself to these tail risks too much, right? So that's the promise of risk management. So the paradox then is that when you need it the most, when the probability of financial distress is the highest, it may be too costly to get. So in a sense, it might be too late for risk management when you find yourself approaching distress. So as financial condition deteriorates, the cost of risk management is going up. So you're going to find it then pretty hard to devise and implement a meaningful risk management strategy when you're approaching these regions over here. So why is there, or would there be, such a paradox then? The answer, according to the research I'm referring to, is that two things are scarce in financially weak firms. One is creditworthiness. You're poor credit at that point. So anyone dealing with you is going to assess your credit risk in a fairly negative light, right? Cash resources are most likely going to be scarce in the normal case. You're down on your luck, you're not performing too well, so cash will tend to be relatively low in many cases. And because these things are lacking, risk management will be costly to execute. And here are some of the papers that I'm referring to in the literature. I will try to explain the essence of these arguments. So risk management here, it's largely risk transfer in the sense of using insurance markets or derivative markets to transfer risk over to a counterparty who's willing to accept the risk for some premium, or in return for some premium. So in this, when you engage with these counterparties, you'll find that in many times risk management must be supported by cash and collateral. They won't agree to transfer risk or allow you to transfer risk when you're too low on these resources, which by definition is the case then in distressed firms. So obviously you need cash to pay for insurance. If you're paying up front, right, that's you need to have cash at hand, to deal with that, and that goes for traditional insurance, but it also goes for the derivative equivalent of that, which is buying put options if you're a producer / exporter, buying call options if you're some kind of a seller or importer. In that case, you need to have money to pay this upfront cash premium, right? When you do that, there's less money to support investment. That kind of takes money away from your investment program. Maybe you have a pipeline of investments that you would like to realize, but you're finding that there's too little money around to do that when you have to simultaneously pay out lots of cash to these providers of insurance. So it might be the case then that there's less investment taking place. You have to scale back that if you want to implement risk management. And that's generally not a good idea according to these models, because when you're at that point and what remains in the firm is likely to be some core investments of strategic importance, right? And they tend to have a high productivity or high profitability, expected profitability, because you're down to the very core of your strategic investments at that point. So scaling back even further would be very costly. So your preference would normally be to invest rather than buying some form of insurance. So that's the problem there. Same thing, a similar thing is going on with forward contracts or future contracts. There's a counterparty involved who's going to be very worried about credit risk then. And to even engage with you and write a contract, you're going to have to post some collateral. More so with future contracts, that is sort of by design there, but it's completely on the table in these bilateral negotiations for a forward contract as well, that they may request some security or some collateral to ensure themselves that if you can't just walk away from the contract and or walk out from it if you're losing money on it, or if you go belly up. So right, so yeah, there's a requirement to produce some collateral, and collateral in this context actually a lot of times means cash. I mean, if you're an airliner or a carrier of some sort, you could of course bring an aircraft as collateral, and maybe that will do, but that's very rare, and it's much more common to simply have post some cash as collateral. So that's again means that you have to have some of it around, and there's less to use for strategic investment, right? So that's referred to as a margin. You have to post some initial collateral, but then there's a margin calls on top of that, which is when you're losing money on the contract, so the credit risk is going up from the perspective of the counterparty. So they're going to come around and ask for more collateral, and that's sort of stipulated in the contract. So you have to oblige and put more cash into this trading account, right? So again, which is going to be scarce in a distressed firms, right? So we have a tentative conclusion here that only cash-rich firms can engage in risk management, and that's something of a paradox indeed, right? Because why would you necessarily need a lot of derivative contracts, let's say, if you're cash-rich? Wouldn't that buffer be enough from a risk management point of view? So it does seem puzzling, right? And the reason being then that cash-strapped firms must prioritize strategic investments. So that's that's the paradox. And this will probably resonate with the many companies who've been in this situation, because many banks will look at lending to this company and giving them the chance to enter derivative contracts as being largely equivalent in terms of the risk exposure to that firm. So the more you're using derivatives, the more you're using up your available credit in that bank. So that is definitely going on in practice. So what this suggests then is that we want to engage in risk management or do risk management when we're still in a good place, relatively speaking, and it's not too late. So risk is on the horizon. So we're seeing the possibility of some potentially bad outcomes. So making risk management interesting, right? But it's still available on reasonable terms, and we can execute it without sacrificing strategic investments or other things we would like to do with our money. So that will be the sweet spot then. So over here, you're fine. You have a strong balance sheet and plenty of cash, perhaps. Your financial condition is mint. You don't have to lose sleep at night over risk necessarily. Whereas if things have begun to deteriorate a little bit, but you're still basically sound, but you're starting to see the possibility of some fairly negative outcomes here. So you have to act here before the condition deteriorates even further, because here the paradox will kick in then, and you will encounter all these problems in executing risk management. So that's a nice mental figure, I think, to try to remember that we need to act when there's still time, so to speak, and before we get into too much trouble already, because we can't realize and react then, and it might be too costly at that point. So a few conclusions then. The paradox involves the notion that risk management may get too costly at the very time you would like to have it, or you would normally want to use it. So the reason being that risk management requires cash or collateral, by definition, then a scarce resource in distressed firms, so that you're crowding out strategic investments, essentially. The more you use risk management, the less money you'll have around to pursue your investment program. So we also were able to conclude that there is a sweet spot for risk management, which is when risk is high enough to be relevant, but the cost of risk is not too high already. So you can still act and execute risk management without it being too costly. All right, those were the conclusions for today. Thanks for listening, and please check out my books on corporate risk management and Empowered Enterprise Risk Management. There's more information on the webpage, riskbudgeting.se. Please like and subscribe. Have a good day.